Sometimes been asked, why do I care so much about market breadth when it comes to the stock market? I even have branded a whole blog series just on the market breadth. Well, let's first step back and make sure we understand what market breadth means and all of its components. So, market breadth is a way of measuring how many stocks are participating in either the buying in the stock market or the selling in the stock market. And in particular, this measure that you're looking at right here is called MMFI in TradingView. So that's the ticker symbol you can use. I call it AT50, shorthand for above the 50-day moving average. So this is the percentage of stocks trading above their 50-day moving averages. What is a moving average? Well, a moving average is the average price over a certain amount of time. So if I tell you that I'm giving you the 50-day moving average for a stock, I have taken the last 50 days of trading, and let's just say in this case, we're taking the last 50 days the closing price of the last 50 trading days, and I've averaged them. So I've summed up those 50 numbers and I've divided by 50 to get a number. Now, over time, you can keep taking that every day forward or backwards. You can do that calculation and you'll end up with a trend line. So for instance, for this chart, let's just take a look. This red line represents the 50-day moving average of AT50. I know it's kind of a mirror in a mirror kind of thing, but I just wanted to point out that it's typically red on these charts. Anyway, that is the moving average. Now, why do we care about moving averages? Because they can communicate trends. So if a moving average is going up and you know that it's the average of the last 50 days of prices, what does that suggest to you? Well, probably prices are trending up. Similarly, if the 50-day moving average is going down, since it's the average of the last 50 days of prices, that means that the stock price is typically going down. Now, just in the abstract, what would you rather buy? Something that whose 50-day moving average is going up or 50-day moving average is going down? I would prefer the going up. There are certain cases to buy when it's going down, and I'll cover that in just a second. Okay, so hopefully we've gotten those basics down. What market breadth is a measure of how many individual stocks are participating in an overall market trend, whether up or down. Market breadth, my primary measure is the percentage of stocks trading above their 50-day moving averages. You can get it here on TradingView with ticker symbol MMFI. I call it AT50 for above the 50. I've branded it that as just my shortcut. And then finally, AT50 is measured on this chart. I made it a dark blue line. Now you're probably looking at this and saying, well, I still don't get it. It's just a bunch of noise. There's a lot of squiggles. It's going up, it's going down. Okay, well, let's put some meaning into this. It turns out that when AT50 gets very low, the odds of a rebound in the stock market become high. The inverse, the inverse is true, which is when AT50 tends to be high, it tends to mark a top in the market. Now, there are some important exceptions, and I wrote an article about this, but that's just the general concept, okay? Now, I'm going to overlay now my overbought line. So that's this black line here, that's at 70%, and my oversold line at 20%. I came up with these lines, or actually, I was given these markers to define overbought and oversold. And with my own analysis, I confirmed that these lines work pretty well. So if AT50 goes above 70%, that's considered overbought. If it drops below 20%, it's considered oversold. Now, there's meaning to this because AT50 spends very little time in either of these regions. Particularly, I'm going to scroll back now. You can see it spends very little time down at the bottom area, right? The meaning of that is as soon as AT50 drops oversold, it's a buying signal for both short-term and long-term traders. Short-term traders can be rest assured that they can buy anywhere in the oversold period, and at some point, when the rebound happens, they should be able to profit. Long-term investors who are relying on the overall years, decades, generations long uptrend in the stock market know that a oversold period is likely a very good time to accumulate more shares in their favorite position. So this is meaningful for both long-term and short-term traders. Now, overbought is probably more meaningful for traders. because long-term investors don't care about oversold periods because eventually, they're counting on the overall long-term uptrend. And again, I'm talking about the indices, not individual stocks, because individual stocks are individual companies. Individual companies have their own individual risk profiles. Okay. At overbought periods now, I've learned over time that you can't just short just because it's overbought, because overbought periods can last a long time. Fear and panic has a much short shelf life than the euphoria and celebrations that are happening when buyers are sending um, market breadth above 70%. One other interesting thing, and this happened a lot in 2024, is that according to my AT50 trading rules, when AT50 is unable to break through that 70% line, that is also bearish. But it didn't work out quite that consistently in 2024. So I mentioned that just to say that these are not hard set rules. You still have to be on your toes. You still have to take into consideration overall context. Okay, so I hope all of that is clear in terms of all the concepts and why I care about market breadth. Let me just finish off by showing you the data behind why I care so much, okay? So this is the article that I wrote to update the data on AT50, and it's called How AT50 Market Breadth Extremes Shape S&P 500 Performance. You'll see here that this is a chart at the bottom at the x-axis. It's the duration of an oversold period. So as soon as AT50 drops below 20%, that's day one. As soon as it comes out of that oversold period, so it closes above 20%, that's the last day. So I measure point to point, what's the duration? Then over those 2 points, how did the S&P 500 perform in terms of its percent change in price? That's what this chart shows. You can see that this purple line maps out the trend line. The black dots are each individual episode of oversold periods. Hopefully what you see is that as time goes on, the likelihood of a negative performance of the S&P 500 grows almost linearly. But if it lasts a short time, then the odds of getting a positive gain are pretty high. And that's this crowd over here. Okay. So the trick is, again, for a long-term trader, they're just going to keep buying along this duration, right? A short-term trader, if they buy here, they have to be prepared for the possibility of the oversold period lasting longer and be ready to continue to buy in increments so that when the oversold period finally ends, and we know it has to end, they're ready to take profits. Okay. Now, on the other side, and I apologize for a mislabel on this chart. I called it over duration of oversold period. I meant the duration of the overbought period. Notice that this chart also it's almost a mirror image, but it's got a lot more dots in it. A lot more dots means that there's a lot more overbought periods than there are oversold periods. And again, hopefully you have an intuition for why that is. It's because fear, panic, and selling that creates oversold periods is much harder to maintain than it is buying that sends shares higher and higher and higher. That's just the psychological physics of the stock market. Now, if you're a short-term trader, you can see here that you can short when you're in an overbought period, and you have a high amount of odds of gain as long as the overbought period doesn't last longer than 10 days. Once it lasts longer than 10 days, you're going to start seeing the S&P 500 tend towards positive performance. And past 20 days, it's almost guaranteed to be positive during that overbought period. And you can see there have been some times that have lasted a long, long time. No short wants to be stuck in a position for that long. So that's the caution there. Okay, so hopefully that all made sense. Again, the article that I wrote, if you want to read more detail, I have some other data in there, some tables that talk about the history of AT50 and the compared to the S&P 500 in terms of duration and length and so on. But the article is called How AT50 Market Breadth Extremes Shape S&P 500 Performance. You can see up here, if you come to my site, you can also subscribe to the blog for free. Hopefully, this all helped you understand why I care about market breadth so much and why you should care, even just as a reference point. You don't have to trade it, of course. And as always, I provide this information. I have these discussions for informational purposes. Please trade and invest according to your own risk tolerances and time horizon. Put your questions and comments down below. I'm always free to answer questions. Please share and like this content so that the algorithm knows what's up and other people can benefit. And if you don't mind, please subscribe to this channel so you can get more content like this. All right. Thanks again. This is Dr. Duru, and I hope to see you again soon at the next recording or on the blog. Bye bye.